There are some types of permanent insurance that allow the policy owner to pay more or less than the planned premium throughout the life of the policy. They are called flexible premium policies, and adjustable life is one of them. It was developed to provide the policy owner with the best of both worlds, term and permanent insurance. And in fact, adjustable life policies can be either term or permanent. So that's flexible right there. The policy owner can adjust a couple of the features of the policy. For example, the premium amount or the premium payment period can be changed as needed. The policy owner can increase or decrease the face amount. They can also change the coverage period and decide if they want to be covered up to age 100 or for a specific period of time only. The policy owner has the option of converting coverage from term to whole life or vice versa. As the insured's needs or financial situation change, they can make those adjustments in the policy. Why would somebody need to have that much flexibility in a life insurance policy? Well, this type of product may be suitable for somebody who doesn't have a steady, reliable income. Maybe they are working on commissions, but still have a family to think about. For example, a real estate agent may have several really good months or years when they can afford paying a higher insurance premium. And then they might have some lean years, so they can adjust the premium amount or even the face amount they are paying for. It helps to keep the insurance coverage in place by allowing the policy owner to adjust it so they can afford it. So that flexibility is great for people who have incomes that are unpredictable. To recap, adjustable life is a flexible premium policy in which the policy owner may increase or decrease the premium amount, the premium paying period, the face amount, and the length of coverage. They can also convert the policy from term to permanent, and vice versa. Universal life insurance, also known as flexible premium adjustable life, gives policy owners the flexibility to modify their premium payments. This means they can increase or decrease the amount of premiums paid into the policy as needed. Policy owners even have the option to skip premium payments without causing the policy to lapse, as long as there is enough cash value to cover the monthly deductions for insurance costs. That's a unique feature of universal life policies. Universal life is permanent life insurance, providing coverage to the insured's age 100. That also means that it has cash value. Do you recall how the cash value accumulates in a policy? It's made up of premium payments and interest that have accumulated over the life of the policy. Once there is cash value, a policy owner has the option to make withdrawals from it. In addition to having a flexible premium, universal life is also considered interest sensitive. What does interest sensitive mean? On top of a guaranteed contract interest rate, which is usually 3 to 6%, a policy owner may get a higher rate based on market conditions. For example, a person purchases a universal life policy with an interest rate of 4%. The following year, the stock market does better than expected, which in turn raises the policy's interest to 8%. However, if the market were to decline, the insurer cannot reduce the policy's interest rate less than the percentage listed in the policy contract, or 4%. When choosing a universal life insurance policy, policy owners have one of two death benefit options, Option A and Option B. Option A is known as a level death benefit. With Option A, pure insurance decreases over time, which lowers the expenses. As a result, the policy accumulates greater cash value over time. The death benefit remains the same for the duration of the policy, unless it needs to be increased to keep the gap between the policy's cash value and the death benefit. This gap is referred to as the IRS corridor, which is established by the Internal Revenue Service. Option B is the increasing death benefit option. So the death benefit increases annually in relation to increases in cash value. As a result, the total death benefit will equal the policy's face amount, plus the current amount of cash value. Unlike option A, pure insurance remains level for life, resulting in higher expenses. Universal life policies allow the partial withdrawal, partial surrender of the policy cash value. That's another unique feature. A partial surrender means the policy owner is allowed to permanently withdraw a portion of the policy's cash value while still keeping the coverage in force. It's not the same as taking out a policy loan that can be repaid back into the policy. A partial surrender permanently reduces the face amount. So, to recap the features of universal life insurance, it is flexible premium insurance, so the owner has the ability to increase, decrease, or skip the premium. It is also interest sensitive and allows for partial withdrawals or partial surrender. There are two death benefit options, option A, level, and option B, increasing. If you see any of these terms on the exam, that means the question is asking about universal life. Now that we've covered what are considered more traditional types of life insurance, let's look at variable life insurance policies and see how they differ, who they are suitable for, and the licensing requirements for producers who sell these products. Variable life insurance, also referred to as variable whole life insurance, provides permanent coverage and is a level, fixed premium product. The variable part refers to it being an investment-based product. What does that mean? While the premium is level or fixed for the life of the policy, the cash value of the policy fluctuates based on an investment portfolio. As cash value builds, it's held in separate accounts, which invest in stocks, bonds, and other securities options, which makes this type of life insurance policies more risky than traditional life policies. Even though there is a guaranteed minimum death benefit in variable policies, the cash value is dependent on market conditions. It could be up or it could be down. If the funds are up and making money, the cash value is going to be up. If the values in the separate account are falling, the cash value is going to drop as well. So again, variable products are riskier than traditional life insurance, and agents must keep that in mind when making product recommendations to clients. Variable products may be suitable for clients who have a higher risk tolerance and a longer time horizon, but may be unsuitable for a conservative client who is nearing retirement, for example. Let's look at another variable product, variable universal life insurance. These policies combine many features of the whole life with the flexible premium of universal life and the investment component of variable life, making it a securities version of the universal life insurance. Just like universal life, variable universal life allows the policy owner to increase, decrease, or skip the premium, increase or decrease the amount of coverage, and make partial withdrawals or surrenders. But because it's a variable product, there are no guarantees on cash values. One other important thing to remember about variable life products is that they are considered both insurance and securities, so they are dually regulated on the state level as an insurance product by state insurance departments and on the federal level as a securities product by the Securities and Exchange Commission, or SEC. Agents who sell variable products must have a life insurance license and a securities license, and are required to be registered with the Financial Industry Regulatory Authority, FINRA. Before we get into other forms of life insurance, let's recap the primary differences between whole life insurance and variable life insurance. Under a whole life policy, both the death benefit and living benefits are guaranteed. The accrued cash value also has a minimum guaranteed interest rate. Over the life of the policy, the face amount remains level, while the cash value steadily grows. Since whole life has no investment component, who bears the investment risk? The insurer. Where does an insurer maintain cash value? In the insurer's general account. Variable life, on the other hand, is investment-based. The policy has a minimum guaranteed death benefit, but the cash value fluctuates based on the performance of the portfolio in which the insurer invests premiums. Because the insurance company is not sustaining the investment risk under the contract, the underlying assets of the policy cannot be kept in their general account. These assets must be held in separate accounts, which invest in stocks, bonds, and other securities, and the policy owner gets to choose which mutual funds they want the cash to be invested in. So then, who bears the investment risk in variable life policies? The policy owner. Unlike whole life, in which the face amount remains level, the face amount in variable life has a potential to increase over the life of the policy. But it may also decrease, depending on how well the investments perform. Let's discuss two specialized types of life insurance policies that may cover more than one person: joint life and survivorship life. These policies are a great option for spouses or business partners. They are less expensive than having to purchase two separate policies. Both types may be purchased in the form of term insurance or permanent insurance. First is joint life. It's a single policy that covers two or more lives. Premiums for joint life policies are determined based on the joint average age of the insureds. So sometimes, if there's a significant difference in the ages of the two insureds, the premium can be reduced, making the joint life policy more affordable than two separate policies. For example, let's say a joint life policy covers two spouses. One is age 36 and the other is 50. By adding both ages together and dividing them by 2, the joint average age would be 43. So that's the age that will be used to determine the premium. Joint life insurance is also called first to die, so that tells you when the death benefit will be paid, upon the first insured's death only. A survivorship life policy, on the other hand, is called second to die or last survivor, so the death benefit will be paid after the last death. That's the only difference with the joint life policy. Survivorship life insurance is often used for estate planning process or for paying inheritance taxes. Key points to remember about joint life and survivorship life policies are: they cover at least two people, and the premium is based on the average age of the insureds. Joint life pays upon the first death, as opposed to survivorship life, which pays upon the last death. The most common way to obtain group life insurance is from an employer as a workplace benefit. Let's discuss what types of groups are eligible for coverage, specifics of group underwriting, and other provisions and benefits offered by group plans. The first thing to know about group insurance eligibility is that a group cannot be formed solely for buying group life insurance. It must exist prior to the purchasing of group life insurance and for other purposes, such as an employer-employee group, an association, or a labor union. Typically, a group life insurance is going to be term insurance, and more specifically, annually renewable term. The employer is the group sponsor, so any group insurance contract is between the insurance company and the employer. The employer is the policyholder and has control over the policy. The employer also receives the master policy. It's the one policy that covers everybody in that group. Each individual insured, an employee, for example, is given a certificate of insurance instead of an actual policy. The certificate of insurance is their proof of coverage. So again, remember, the group sponsor receives the master policy, and the insureds within the group receive certificates of insurance. Another key distinction between group and individual life insurance policies is the underwriting process, specifically relating to insurability. Unlike individual policies, eligible insureds under a group policy typically do not have to prove insurability. The policy will be issued based on the nature and size of the group. Their turnover rate, meaning how often younger, lower-risk employees enter the group, and older, higher-risk employees leave. The underwriters will look at the financial strength of the group and the group's past claims experience. But as far as the underwriting process for individual insureds, it is very easy. So what if an individual decides to leave the employer? What happens to their life insurance coverage? For that situation, group life insurance policies have the conversion provision. Eligible employees, usually those who have been covered under the policy for at least 5 years, will be allowed to convert to individual permanent insurance with the same amount of coverage. Note that the conversion is not term to term, but term to permanent insurance with cash value, such as whole life. Employees typically have 31 days from the date of termination from the group policy to exercise their conversion right. Group coverage continues during the conversion period. So if the insured dies during that period, the group policy will pay the death benefit as if the employee was still covered under the group plan. The individual policy will be issued for the same amount of coverage, but the premium will be higher than for group insurance. The one big advantage of conversion is that the insured does not have to prove insurability, so they will be automatically eligible for individual coverage. That's very important. Let's discuss another type of life insurance that's designed to insure the life of a debtor and pay off loans if a debtor dies. We are talking about credit life insurance. Credit insurance is typically offered in the form of a decreasing term policy. Remember how a decreasing term policy functions over time? The death benefit decreases over the life of the policy in the direct proportion to the amount of unpaid debt. At the end of the policy term, there is no death benefit. If the insured dies before the debt is paid off, that's when the policy will step in and pay off the balance. Because these policies are designed to pay off debt, the initial amount of coverage cannot exceed the total amount of indebtedness. Now, who is the owner, the insured, and the beneficiary in a credit life policy? The creditor is the owner and beneficiary of the policy. The debtor is the insured and is responsible for paying policy premiums. So that's different from any other types of insurance, where the owner usually pays the premium. In credit life insurance, if the insured dies, the death benefit is received by the creditor to pay off outstanding loans. If credit insurance is written as a group policy, the creditor receives the master policy and each debtor receives a certificate of insurance. Creditors may require a debtor to maintain life insurance, but cannot require the debtor to purchase coverage from a specific insurer. The credit insurance policy term begins on the date the loan is made. Key points to remember: credit life insurance is decreasing term. It cannot exceed the amount of the indebtedness and cannot pay out more than the balance of the debt. The creditor is the owner and the beneficiary, and the debtor is the insured and pays the policy premium. Life insurance and annuities are both insurance products offered by life insurance companies, but they function very differently. Life insurance is intended to provide for beneficiaries after the death of the insured. On the other hand, annuities guarantee payments to the annuitant while they are living, and often until their death. And that's one of the main benefits of an annuity. Depending on how they're structured, Annuities can protect people against running out of money before they die. As you are studying, you may find annuities a bit confusing, but there is a simple way to explain them. Imagine an annuity as an open jar being filled through a funnel. All the money is going into this jar. Once it's full, the funnel turns, and the money comes back out. Let's get into the specifics. Money goes into an annuity during the accumulation period, also called the pay-in period. This is when the money in the account is growing, either through deposits or interest that's earned on those payments. Then comes the annuitization period, or the payout period. This is when the money starts coming out of the annuity in the form of payments to the annuitant. It's important to know that the accumulation period and the annuitization period cannot overlap. Once payments begin from the annuity, no more money can go in. So who are the parties to an annuity? They are the annuity owner, the annuitant, and the beneficiary. The owner of the annuity is the purchaser and the person who pays the premium into the annuity during the accumulation period. The owner also has all of the ownership rights in the annuity. The owner can be an individual or a corporation or trust. The annuitant is the recipient of payments from the annuity. The annuitant is usually the same person as the owner of the contract, but they don't have to be. Remember, the annuitant must always be a natural person because an annuity is written based on the life expectancy of that person. Finally, there's the beneficiary. There will always be a named beneficiary when an annuity is in the accumulation period. If the owner of the annuity dies while money is still going into the annuity, the insurance company can't keep that money. They will pay it to the beneficiary. Or if the annuitant dies during the annuitization or payout period, and there is money left to distribute from the annuity, that money will also go to the beneficiary. Putting all the pieces together, the owner puts funds into an annuity during the accumulation period. At some point, the owner triggers the annuitization period, starting a stream of income payments to the annuitant. If the annuitant dies and there is money left in the annuity, it goes to the beneficiary. One of the reasons people buy annuities is the deferred growth. They put their nest egg or their rainy day money in the annuity to provide a stream of income when it's most needed. They can also use annuities to liquidate an estate or spend down assets in the form of a steady stream of income. Annuities are sometimes called living benefits because the annuitant is receiving payments while still alive. When it comes to paying the premium during the accumulation period, they can make a Annuity owners have options when it comes to paying the premium during the accumulation period. They can make a single premium payment, or they can choose to make periodic payments. If the owner chooses the single premium option, the premium is paid in one lump sum, all at once. If the owner chooses the periodic payments option, the premium is paid in a series of deposits over a period of time. These payments can be level, meaning payments are regular in amount and frequency, or flexible, meaning the owner decides how much to deposit and when. The decision the customer makes may depend on the resources the customer has at hand currently, and what resources they're expected to have in the future. For example, a customer who has just received a large pension upon retiring may choose the single premium option and put their whole pension in the account. They aren't expecting any additional regular income to add to the annuity, and the annuity will help protect the money and help it grow over time. The single premium option may also be suitable for customers who inherit a large sum of money, or those lucky lottery winners. The periodic payment option, however, gives customers an opportunity to continue adding money to the account throughout the accumulation period. Level periodic payments help an annuity grow steadily. Flexible premiums, however, might be a good option for people who are expecting to be able to contribute more money in the future. The next classification of annuities is based on how the annuity premiums are invested. So, an annuity, essentially, keeps the annuitant's money in a safe place. But the money isn't just sitting there. Part of the purpose of an annuity is to grow money, and that's not just happening through premium payments. There are two major types of investment choices for annuities: fixed annuities or variable annuities. Fixed annuities have long had a reputation for financial security. They offer a guaranteed minimum rate of interest, which is usually pretty low, 2 to 3%. That's a guaranteed fixed percentage of interest that the insurance company is going to pay year after year for the entire accumulation period. With a fixed annuity, premiums are deposited into the life insurance company's general account, comprised mostly of conservative and safe investments, such as bonds. The money earned is how the insurer is able to pay what they've promised into the customer's account. So let's say the annuity's guaranteed minimum interest is 3% per year. If the investment's earned 5%, the insurer has enough money to cover the 3% fixed interest rate and will keep the remaining 2% as their gain. However, if the investment's only made 2%, the insurer still has to pay the customer the guaranteed minimum interest, or 3%. This explains why the insurer bears the investment risk in fixed annuities. So who would buy a fixed annuity? Usually, it will be fiscally conservative individuals who may be close to retirement and need guaranteed savings for their retirement. So somebody age 50 or older, for example. Now, variable products are different. Variable annuities combine the advantages of fixed annuities tax deferral with investment flexibility and access to a wide range of investment options. Variable annuities allow personalization of an investment strategy based on an investor's goals, time frame, and risk tolerance. Premiums paid during the accumulation period are placed in the insurer's separate account that is usually invested in common stocks. This means that the investment will vary according to the fluctuation in stock prices. So variable annuities are riskier, and it's the annuity owner who bears the investment risk. Variable annuities have no guarantees. There's also a difference in requirements for agents selling these products. To sell a fixed annuity, an agent is only required to have a life insurance license. To sell a variable annuity, agents must be dually licensed in life insurance and securities. Now, there's also a third type of product: equity indexed annuities. They are fixed annuities that invest on a relatively aggressive basis to aim for higher returns. So they remove some of the risk of variable annuities, but can offer better results than fixed annuities. Like all fixed annuities, equity indexed annuities guarantee a minimum interest rate. But they also offer the current indexed rate, which is often tied to an index like the Standard & Poor's 500. So if the index is performing better than the guaranteed minimum interest rate, the higher percentage is credited to the annuity. Again, equity indexed annuities are less risky than variable annuities, but are expected to earn a higher interest rate than a fixed annuity. In addition to choosing how money goes into the annuity owners may also choose when the money comes out. An immediate annuity is used if owners decide they want to start getting payments within a year of purchasing the annuity. This might be good in a situation for a retired person who is funding the annuity with their pension, making a single lump sum payment, and who wants to start getting income from the annuity quickly. Remember that in an immediate annuity, that one deposit is it. There is no more money going into that annuity. That's why it's called a Single Premium Immediate Annuity, or SPIA, and it is designed solely for the distribution of income. Income payments start within 1 year from the date of purchase. Typically, an immediate annuity will make the first payment as early as 1 month from the purchase date. SPIAs bring peace of mind to retirement because the income they provide is stable and secure and cannot be outlived. If someone can't afford to wait a year or more before receiving payments, they would choose a deferred annuity. Payouts from the annuity are deferred, or put off, to start at some point in the future, but no sooner than 1 year after the purchase. A deferred annuity allows time for the annuity to grow and gives the owner the opportunity to add more money to the annuity before it starts paying out. A deferred annuity can be funded with a single lump sum payment or periodic payments. In contrast, an immediate annuity can only be funded by a single lump sum payment. Another key takeaway is that, unlike other annuity products, immediate annuities do not have an accumulation period. Annuities are designed to be long-term investments, but the funds don't just sit in an account. The company uses the funds in that annuity to make investments, and they make money on those investments. That's why all annuities have some type of surrender charge. The purpose of the surrender charge is to help compensate the company for loss of the investment value due to an early surrender of a deferred annuity. Surrender charges are the penalty an owner must pay if they want to get out of an annuity contract early. Surrender charges typically are a percentage of the total premium deposited and decrease to zero over a period of years defined in the contract, usually between 5 and 10 years. Here's an example of how that works. A 7-year surrender charge is pretty typical. If an owner decides to surrender the annuity in the first year, they're going to pay a surrender charge of 7% of the annuity value. If they surrender it in the second year, the charge will be 6%, third year, 5%, and so on. You see how the charges drop each year? Eventually, the surrender charge drops to zero. So if the annuity is surrendered in the 8th year or later, there will be no further surrender charge. At an early surrender, the owner will receive the premiums paid into the annuity plus interest minus the surrender charge. Now let's look at the choices the annuity owners have when it comes to the distribution of income from the annuity. Note that the annuity payout options are very similar to the settlement options used in life insurance that determine how the policy proceeds are distributed to the beneficiaries. To make it simple, let's assume that the annuity owner and the annuitant are the same person. They can decide whether they want to be paid for a specific length of time or a specific amount of money. Those are the options. Payments can be for a fixed period or for a fixed amount. If the annuitant chooses the fixed period payout option, they're going to decide for how long they want to receive payments. They're determining the length of the annuitization period. Once the annuitant decides on that period of time, the insurance company determines the size of each payment, based on the value of the account and projections for future earnings. If the annuitant chooses the fixed amount payout option, they're going to decide how much they want each payment to be. And again, the insurance company will calculate how long the payments will last. Under both payout options, the payouts continue regardless of whether the annuitant is living, until either the fixed period ends or the fixed amount is paid out. There are no life contingencies. That's why these annuities are also called annuities certain. Purchasing annuities is like having life insurance in reverse. Life insurance is purchased for the risk of dying too soon, and annuities are purchased for the risk of living too long. Annuities protect a person against the possibility of outliving their income. Annuities are purchased, for the most part, to provide or supplement retirement income, to ensure that the annuitant will have a steady, dependable income in their golden years. But an annuity can be used for any situation that requires a steady stream of income at some point in the future. Let's look at some of the common uses of annuities in greater detail. Since annuities are a popular means to provide retirement income, they are often used to fund qualified retirement plans, which means they meet the IRS guidelines to receive favorable tax treatment. An annuity provides guaranteed income by liquidating a person's estate according to the terms and provisions of the annuity contract. Annuities are also a good financial choice for people who come into a large amount of money. It could be from an inheritance, a pension payout, awards from a lawsuit, or lottery winnings. A person may purchase a single premium immediate annuity, which would convert the lump sum into a stream of income for the annuitant almost immediately. Could be as soon as just after 1 month of purchase. Another common use of annuities is to fund education. An annuity can provide savings on a tax-deferred basis for the education expenses of the annuitant or their children or grandchildren. It's a great way to set money aside and let it grow tax-deferred. When the time comes to meet educational costs, the annuity will cover those expenses. Remember that life insurance creates an immediate estate. Annuities do the opposite. They help liquidate an estate, and depending on the type of annuity, to provide income to the annuitant for a specified period of time or for the rest of their life. Suitability is a particularly important consideration with annuity products. These are products that are designed to grow money and provide income to the annuitant, which often needs to last for the rest of their life. Some annuity products are riskier than others, so it is very important for producers to know their clients and their financial situation to recommend the most suitable product for each person. To determine suitability of a product for a particular client, a producer should ask questions like, what's the client's current financial situation? How much money can they put aside? What are their long-term goals? Do they understand that annuities are long-term products? Start with the basics. How old is the client, and how are they planning to use the annuity? A younger individual planning to save for retirement decades in the future has different financial needs and timeline than an older person close to retirement who would need guaranteed savings in just a few years. Knowing a client's financial needs and their timeline is key in determining a product's suitability for them. A customer's tax status is also important. Remember that the growth on annuities is going to be tax deferred, which means when the money comes out and is paid to the annuitant, that money is going to be taxed as ordinary income. Will the annuitant be able to afford to pay those income taxes at that time? A customer's investment objectives and risk tolerance are also important factors. Some hoping to grow their money quickly would be okay with a more aggressive approach and may be in a position to withstand the turbulence of the stock market, as opposed to someone who is nearing retirement and prefers slow but more dependable growth and a guaranteed rate of return. All of those factors go into determining how suitable a specific annuity product is for a specific customer. It goes beyond knowing how those products work. Information from the customer is key to making a well-informed and suitable recommendation. But no matter the situation, remember this: when making a recommendation for an annuity, a producer must always act in the best interest of the customer under the circumstances known at the time the recommendation is made. In making a recommendation, the producer must exercise reasonable diligence, care, and skill, and must know the customer's financial situation and objectives, insurance needs, and risk tolerance. Understand the available product options and how they would work for the customer. Have a reasonable basis to believe the recommended option effectively addresses the consumer's needs, and communicate the basis for the recommendation. There is a lot of information to learn and understand about annuities, so let's recap everything you've studied so far. First up are the two phases of an annuity. The accumulation period is when money is being paid into the annuity or being accumulated with interest for some time in the future. The annuitization period is when money is coming out of the annuity and is being paid to the annuitant as income. The annuitization period may also be called the annuity period, payout period, or liquidation period. Pretty self-explanatory terms. Note that once the annuitization period starts and funds are being paid out to the annuitant, the accumulation period must stop. If there's money coming out of the annuity, no more money can go in. Now let's review the parties to an annuity. You need to understand the difference between the annuity owner, the annuitant, and the beneficiary. The owner of the annuity is a person or an entity that purchases the annuity and who has the annuity rights, such as naming the beneficiary or deciding when to annuitize. The annuitant is the person who receives payments from the annuity. The key thing to remember about the annuitant is that they must be a natural person, the actual human being, because the annuity is written based on that person's life expectancy. The owner and the annuitant are usually the same person, but they don't have to be. Finally, there is the beneficiary. The beneficiary will receive annuity assets if the annuitant dies during the accumulation period or receive the balance from the annuity. So, how does money get into the annuity, or how is the annuity funded? It can be with a single one-time premium or with periodic payments, which can be fixed or flexible. The next category of annuities is based on how premiums are invested. The three basic types that you need to remember for your exam are fixed, equity indexed, and variable. A fixed annuity gives the annuitant a guaranteed interest rate to grow the money. The premiums are deposited in the company's general account in conservative, safe investments. An equity indexed annuity is also a fixed annuity that provides the same guarantees, but it may offer the annuitant a higher rate of return if an index that it is tied to, like the S&P 500 for example, is performing well. Finally, there are variable annuities that are invested through separate accounts and are more risky because the investments will vary according to the fluctuation in stock prices. They provide no guarantees to the annuitant, And it is the annuity owner who bears the investment risk, and not the insurer. Remember that annuities are also classified based on when the annuity payments begin. And the two categories are immediate and deferred. Immediate annuities are purchased with a single lump sum payment and provide income payments that start within 1 year from the date of purchase, sometimes as soon as 1 month after the purchase. For your exam, think of it like that. Because the annuity was fully funded with one lump sum premium, it may start paying income immediately. With a deferred option, payments begin sometime after 1 year from purchase, so they are deferred until sometime in the future. The longer the annuity is deferred, the more flexibility for payment of premiums it allows. And finally, annuities may be classified based on how the annuity funds are paid out. Here are several examples of payout options. Life only, or pure life, annuity pays out only until the annuitant's death. Joint and survivor annuity pays to 2 annuitants, but benefits are reduced after the death of the first recipient and continue until the death of the second. There are also fixed period and fixed amount payout options, known as annuities certain, because they guarantee that the entire principal will be paid out, whether the annuitant is living. A fixed period annuity pays out only for a specific period of time, while a fixed amount annuity pays a specific amount until the funds are exhausted. When you see all these terms on your exam, go back to the basics. If a question is asking about how the annuity is funded, well, that will depend on how many premiums it took to fund it. One lump sum premium or several periodic premiums. If it's about investments, remember that fixed annuities have guarantees and are less risky, while variables imply fluctuations, so those annuities are more risky and have no guarantees. If a question is asking about payout options, think about how many lives are covered and how long the payments will last.